Hi everyone, my name is Cyril. I'm the co-founder of Swap Finance, an AMM that strongly reduces impermanent loss. And today I'm going to show you how impermanent loss is a key issue for wider DeFi adoption and how to fight it as a liquidity provider on automated market makers. So maybe before that, just a quick definition. So impermanent loss or losses in capital that happen when you're a liquidity provider on automated market makers like Uniswap, SushiSwap. And that happen basically when the price of the assets you supply liquidity to decorrelates. So it's a key issue for DeFi adoption. First, because it's a very sneaky problem and very hard to understand for the average DeFi user. And it's not advertised on the AMMs, basically. So basically, you get those insidious losses, which can basically prevent users from understanding exactly what they are doing with their liquidity. The second big problem with impermanent loss is that it's responsible for billions of dollars of losses for liquidity providers every year. A study has been made by Bancor on that. They have analyzed the returns of liquidity providers on Uniswap v3, which is the most capital efficient AMM. And basically what they've demonstrated is that approximately 50% of LPs are actually losing money on Uniswap v3, 50%. And when you take the absolute numbers, it gets really crazy. Just based on 5 months and less than 50% of the pools, $260 million had been lost in Uni v3. So if you just triangulate that with the whole DeFi and AMM space, you get losses that amount the billions of dollars, basically. So basically, it's a huge problem for LPs that are losing a lot of money and therefore not providing liquidity or just getting wrecked. When you zoom out, though, it really becomes an interesting problem and key for wider DeFi adoption in the sense that it also affects traders. So the LPs are not the only one getting wrecked due to impermanent loss. Basically, when you think about the trading cost on an AMM, it's a function of two variables. So you have the price impact, which is the ratio of the size of your trade out of the size of the pool you're trading with. And you have the trading fees, which is the commission that's given to the liquidity providers. So first, the trading fees have to be high for liquidity providers to just break even. So they charge approximately 30 basis points on average for volatile pairs, which is much more than centralized exchanges and limits the liquidity available on-chain for projects and for tokens. The other thing is price impact. So basically, as we've seen, providing liquidity on a traditional AMM is not a very profitable investment. So a lot of people don't do it. They are very irrational. So the amount of total liquidity available for providing, for AMMs is much lower than its potential, leading to high slippage. So in short, it's a huge problem for all types of users in DeFi, traders, liquidity providers, and it's scary. Also, I would like to maybe give you a more concrete vision of what it means for you as a liquidity provider, so that you can fully grasp the extent of the problem. So first, maybe let's try to conceptualize a bit more what is impermanent loss. The reason why impermanent loss happens is that traditional automated market makers determine the price and the volumes of the assets on their platform based on the demand for each asset. So, for instance, if you have a NIS DAI pair on an AMM, like Uniswap, and let's say the starting price of ETH is $1,000. If the AMM sees that people are buying ETH, it will increase the price, and it will therefore lower its ETH exposure. So in the end, when the price rises to $2,000, you've sold ETH along the way, so you're less exposed to ETH, the best asset, and you have more DAI, which is the not so good asset, because it's like underappreciated against ETH. So essentially, impermanent loss is filling your bags with bad assets and selling good assets, essentially. And this can get really bad. Imagine, so we start with an ETH price at 1,000. If the price of ETH doubles, which can happen pretty fast in crypto, you would get approximately 6% loss on your bags against someone who has just kept their assets in their ledger. And what you get when you get really strong trends, that's where the issue starts to be really big. For instance, when you look at the figures from the last bull run, the price of ETH between bottom to top has approximately had a multiplier of 30. And basically, the users who put their assets into AMMs, they had 1/3 of the bag of those who didn't. So that's huge. You may think, okay, it's bad when the assets are going up, but it kind of helps you to hedge yourself. But unfortunately, that's not the case, because if prices go down, if prices go down as well, it's actually the same issue that happens. Why? Because when the ETH price goes down, in our example, essentially it means that the price of DAI has increased. So the good asset becomes DAI, and the worse assets becomes ETH. And you're going to fill your bags with ETH. So I don't want to scare anybody, because it seems like we're entering a bear market. But if you have assets in AMMs, you're going to get even more damage if they start to decrease in terms of prices. So for instance, if ETH from $1,000 goes down to $80, which I think was around the bottom of the last cycle, you would lose approximately 50% of your savings compared to someone who kept those ETH and DAI in their ledger. So what can you do? To be honest, there are a lot of options, but none of them seem very great. So the first and probably most rational thing is to just not provide liquidity on AMMs. What you can do is provide liquidity on lending pools, on like use staking services, or use Curve, for instance, which doesn't have impermanent loss because it's stable assets, so no prices variation. The problem with lending and staking is that basically the returns are not so attractive. And the issue with Curve is that you don't get exposure to the assets. You don't get exposure to ETH. You can farm stables, but you cannot farm assets that are volatile without impermanent loss. So then if you really want to farm and to provide liquidity in AMMs, you will have to face some drawbacks. So first, you can try to manage your position in a very active way. You try to time your entry and your way out of a pool so that the price goes up and then goes back to its initial point, and you would avoid impermanent loss. The problem is it's super hard to do. It's super time consuming. And well, if you look at the average of people who try, usually it's not much better than people who are just passive liquidity providers. Another thing you can do is to use what's called a concentrated liquidity manager. So basically, you can think of those products as asset managers automated that are built on top of Uniswap v3 and that can manage your position on Uniswap v3 for you. The concept is great. The problem is that data doesn't show that they overperform other LPs, for now at least. So not such a profitable investment for now. Actually, the people that make the most money on Uniswap v3 are bots that just spam liquidity, what's called just-in-time liquidity, for one block. Other options include Bancor or Open, which are more in the insurance area. So basically what they say is that they will, so you can farm on their exchange. I mean, for Bancor, you farm on their exchange, and they provide an insurance with their own token that will compensate you in case you get impermanent loss. And Open is more about like being able to buy an option which acts as an insurance against your Uni V2 or V3 position. Those approaches can work, but they are faced by one big problem, is that they're expensive. Why is that? Because it's always more expensive to buy an insurance than to solve the actual problem. Imagine the following example. You have a house, and you don't want people to steal your stuff, right? So one thing that you can do is to put a lock on your door. Another option is to leave the door and the windows open and to buy an insurance for burglary. Maybe not the most efficient way to solve the burglary problem, right? The last option that's been tried is Dodo. So basically what they did is that they used different algorithms to act against impermanent loss. They actually managed to cut impermanent loss, but they created another problem, which is called inventory risk, and which is very frequent in traditional finance. And so today, actually the model doesn't work on volatile assets, so they focus completely on stable assets, which is more than 85% of their volume. And then comes Swap, which is not available yet, but which will be soon. So basically at Swap, we think that impermanent loss is a key issue to be solved for wider DeFi adoption and to provide value to both liquidity providers and traders. We have a triple value proposition. The first thing is that we strongly reduce impermanent loss. The second aspect, so for liquidity providers, the second aspect is that we have multi-asset pools, which means that you can provide liquidity on more than two assets, so like Balancer does. And the last part is we have low trading fees, lower most of the time than other AMMs. And why is that? Because we implement a new approach to market making on AMMs. We use first Oracle-based pricing, so we leverage data feeds from Chainlink, and this enables us to strongly reduce arbitrage. Arbitrage is what is used by AMMs to actually define the price on their platform, and it costs them billions of dollars every year, which is in impermanent loss. And by strongly reducing the arbitrage, we're able to actually give this value back to both liquidity providers and traders. The other aspect that we are introducing is a dynamic spread approach, which is very similar actually to what active market makers on TradFi and in TradFi and in CeFi do. And this enables us basically to protect the pool and the liquidity providers from risky conditions and manage the inventory risk that Dodo is facing, basically. Maybe to finalize this presentation, I would like to say a few words about what a no impermanent loss DeFi could unlock for us. So first, the first thing that's very useful to my mind is the fact that profitable market-making strategies can be open for everyone. In CeFi and TradFi, market making is something for very sophisticated investors with very complex algorithms. AMMs have enabled anyone to benefit from those yield strategies, but the problem is they don't work. And thanks to that, we can finally offer yield strategies for everybody. The second aspect is it enables to reduce trading fees and increase the liquidity available on-chain. Today, approximately 10% of the trading volume happens on-chain, and 90% happens on centralized exchanges. Removing impermanent loss is probably one of the best ways to diminish the fees also for institutional investors and enable anyone to have an on-chain trading experience, which is key to a wider DeFi adoption. And the last part is it's also great for building a wider ecosystem and removing a cost barrier for DAOs. So basically today, DAOs face a huge cost by providing liquidity on traditional AMMs. And with solutions like Swap, we expect DAOs to finally transform this liquidity cost into an option for yield. So thank you very much for your attention, and don't hesitate if you have any questions.
Thanks for your performance earlier. Really interesting. Impermanent loss is a real issue here. And from what I understand, the swap has resolved this by unique way. Yeah. And when to expect us to try it out, how it works?
Thanks for your question. So basically, we are already live on testnet, so you can try our product on the testnet, and we will be launching in a few weeks on Polygon. So you can follow us on Twitter, and you'll get all the updates.
Yeah, and about profitable market-making strategies. So just Swap provides us with the strategies automatically, or we definitely need to do like we did with Uniswap and other exchanges, like doing this manually, like you mentioned. It's really difficult and time-consuming to always to be searching for that.
Sorry.
I mean, just like you told us, and I know personally that it's really difficult and time-consuming to watch, to search the price and reduce your impermanent loss. We do it manually. In a swap case, is it going to be kind of automatical for us?
Yeah, so basically it's a big issue. So yeah, it's a completely passive value proposition. The issue with Uniswap is that you need to dedicate a lot of time, and you have to be really an expert if you want to be a profitable liquidity provider. And if you provide liquidity on our platform, you just have to provide liquidity, go wherever you want, come here at the conference, and forget about your liquidity. And whenever you would like to withdraw it, this wouldn't affect your performance in any case.
Any other questions, maybe?
Historically, people use LPs for APY. So if somebody is going for an ILP option, how does it combat or offset the amount of earnings they would otherwise make on an APR or an APY basis? Or is that even a relevant question for swap?
So do you mean like how do the APYs compare to traditional AMMs?
Yeah. Yes, traditionally AMMs vis-a-vis ILP AMMs with or without APYs, how do the two of them compare?
So basically, in traditional AMMs, essentially, so we've made some internal simulations that we have not released yet, but essentially the payoff is more or less neutral when you take into account both trading fees and like impermanent loss. But the problem is like you face a high risk, so you have a high chance to have a negative payoff. So at Swap, basically, we are not yet able to provide like estimates of the APYs because the algorithm is not live yet. But to give you a comparison, market makers in traditional markets or in centralized finance usually experience APYs between 5 and 12%, I would say. per annum. So it's not the crazy yields that you advertise with liquidity, mining, etc., and that were advertised in the past 2 years. But I think we're starting to come out of it, following the UST crash and the potential bear market. But still significant.
Do you think a lot of your customers might actually be traditional AMMs themselves? Because they experience a lot of this volatility, but in trillions.
I mean, it's definitely possible. Like arbitrage between AMMs is definitely something that's used and can be used in order to provide the best price to traders at all times.
It seems no more questions. Thank you once again. Please, one applause for Mr.
Thank you very much.